Hello everyone, thanks for checking out my video. Quick announcement, there won't be any stock market videos for the next 2 weekends, but I have prepared a special edition video which will be released during one of the weekends. I'll be back with the regular weekly content on the 24th May weekend. Okay, back to the stock market. Well, US stocks surged last Friday, with the S&P 500 posting its longest winning streak since November 2004. A strong jobs report and a possible progress in US-China trade deals have helped to boost the sentiment on Wall Street. With this latest rally, the S&P 500 has now fully recovered from the losses triggered by President Trump's sweeping tariff announcement on 2nd April, also known as the Liberation Day. So does this mean we are out of the woods? Is the market turmoil finally over, or is there more pain still ahead? Let's discuss them in this video, and as always, do watch till the end, alright? Okay, as shared, the S&P 500 recorded its longest winning streak in over 2 decades, as it posted a 9 consecutive session of gains last Friday. The latest feat came after earnings from big tech, a strong monthly US jobs report, and the prospects of potential tariff talks between China and US. Very quickly, let's break them down. First up, let's talk about the jobs report. The US added 177,000 jobs in April, exceeding economists' expectations of 133,000. The unemployment rate came in at 4.2%, which is in line with estimates. This report has given the stock market a sign of relief and helped to alleviate concerns of an economic slowdown following a mid-week report that showed a contraction in US GDP for the first time in 3 years. The negative GDP was likely caused by a tariff-induced flood of imports. In addition to the strong jobs report, investors also cheered on news that China is evaluating the possibility of starting trade negotiations with the US. They are saying that the door is open if the US agrees to pull back on reciprocal tariffs. On the earnings front, it was mixed results from the 4 big tech companies: Apple, Amazon, Microsoft, and Meta. First up, Apple warned of a $900 million tariff headwind this quarter and cut its share buyback program by $10 billion. This has sent its share price lower despite its quarterly earnings beat. Meanwhile, Amazon's share price dropped slightly after they also beat earnings estimates, but issued disappointing guidance that pointed to tariff and trade policy as factors. However, during mid-last week, both Microsoft and Meta posted monster quarterly performance and issued strong forecasts. Both share prices popped more than 8% in 2 days. But overall, we didn't get much bad news last week, which was why the stock market rallied as the 3 major indexes posted their second positive week in a row. In the week ahead, the Federal Reserve will meet on the 6th and 7th May. For this meeting, the Fed is widely expected to hold interest rate at current rate. However, investors would be hoping the central bank can resume their rate cut trajectory in the months ahead, or as early as June. Most investors would also be focusing on what Powell has to say during his press conference on 7 May Wednesday. All in all, I believe this meeting, or rather, Powell's words will definitely test the latest stock market's sharp rebound. If the Fed starts to signal that their inflation concerns are fading and suggest that they are closer to a cut, then I think that will be well received by the stock market. However, I do think Powell might want to position himself a bit more hawkish to push back on the narrative that the Fed is going to be influenced by the White House or President Trump. So I don't know, the market might not like this. It depends on how hawkish Powell is, to be honest. Meanwhile, the earnings season is still underway. So far, corporate results reported over the past few weeks have generally exceeded expectations, with about 2/3 of the S&P 500 having reported, and on average, companies' earnings are 7% above expectations versus a long-term average of 4.3% above estimates. Let's see if this performance can continue this week, with some notable companies lining up, such as retail favorite Palantir, AMD, Uber, Disney, Supermicro, Computer, Coinbase, Cloudflare, and the list goes on. Last of all, without me saying, everyone knows that the trade developments will remain in focus. The market is hoping to see some solid side deals with some of the US trading partners as the clock towards the 90-day tariff pause is ticking. Moving on to the technical analysis segment, the broader market looks pretty positive as SPY went above the 50 moving average and the critical 61.8 Fibonacci level at around 562. This coming week is very important because we are very near the important 200 moving average, which currently sits at 570. If SPY can close above this 200 moving average, it's a big step towards reversing the downtrend. In fact, if SPY can continue to stay above the 200 moving average, then I would say the overall trend has officially turned bullish. But just to add, this 200 moving average will be a heavy resistance by itself, so don't be surprised if SPY faces difficulty getting above it or even gets rejected. If it does get rejected, watch for a potential retest of the 61.8 Fibonacci level at 562. If it bounces off here, then I think the next leg up will likely see SPY reclaim the 200 moving average. However, if SPY goes below the 61.8 Fibonacci level, don't panic yet, we still have a decent support at the 50% Fibonacci level at around 547. Similarly, if SPY can bounce off from here, then the reversal of downtrend is still in progress. But in the next few weeks, if SPY somehow falls below the 50% Fibonacci level, then I would say the bearish trend is continuing. Let's see where the broader market is when I come back in about 2 to 3 weeks time. Let's now jump over to Apple. Well, Apple was looking good with that 6 consecutive green candlesticks until it reported its earnings. Right now, Apple has an important task, and that is to get above that green resistance line at around 206 and the 50% Fibonacci level at around 210. If last Friday's sell-off was a knee-jerk reaction because of its earnings, the bulls need to step in quickly to bring Apple above those two levels that I have just mentioned. By doing so, then I think there is a high likelihood that Apple can fill almost the entire gap that you see on screen, between 214 and 221. I would think it should minimally head towards the 61.8 Fibonacci level at around 219. And if somehow Apple can close above this 61.8 Fibonacci level when I'm away for the next 2 weeks, I do think the next target, which is the 200 moving average, will be very much in sight. This level is around 227. But all this can only happen if Apple can quickly reclaim that 50% Fibonacci level. Otherwise, if you zoom out the chart, you will realize that there isn't much support at the current range, which means we could easily hit 200 or fall below it again. In fact, the moment we broke below 200, I am expecting Apple to fill that gap between 193 and 195. That being said, I think so long as we don't get crazy stuff from President Trump, it's quite unlikely for Apple to test the recent low of 169 in the next few weeks. To put it simply, I think the short-term bottom for Apple is in, for now. Alright, let's now check out Tesla's chart. Tesla looks interesting to me, but yet straightforward. If you could recall, I shared in my last video that Tesla has been trading within this consolidation zone, which stretches from around 214 all the way to 291. Why I said the chart is interesting is because Tesla was testing the top end of this consolidation zone for the entire of last week. And coincidentally, this top end of the zone is also near where the 200 moving average is, making it a double resistance level. Just to add, the share price went near this level previously as well but failed to get above. It is interesting because this time around it seems like the bulls are pushing it very hard, but somehow the bears are defending that level pretty well as well. So watch this level very closely this week. Let's see if we can get a result on who will emerge victory, the bulls or the bears. If the bears win this tug of war, then I would expect Tesla to grind towards the bottom of the consolidation zone. It may not hit 214 or the bottom of the zone eventually, but basically it will head towards that direction if we get a rejection at the top end of the consolidation zone this week. Maybe, minimally, we might see 250's range. One huge indication or confirmation of this bearish movement is Tesla losing the 38.2 Fibonacci level at around 273, as well as losing that green zone, which ranges between 264 and 272. If this green zone breaks, that's your cue and signal that we could be headed towards 250s range at least. Well, on the other hand, if the green zone holds and Tesla continues to push and test that top end of the consolidation zone, we might break above it eventually. When that happens, Tesla could easily fly towards above 300, probably hitting 309 at least, where the 61.8 Fibonacci level is. And if we can get a few solid candles above 309, then that's very good news for the bulls, because I would expect Tesla to fly even higher and further. Okay, since I will be away for a few weekends, I thought to just add a pointer. Watch that 200 moving average closely. Even if Tesla gets above it this week, it will not fly up in a straight line. Expect the share price to retrace and retest the 200 moving average in the following weeks. From there, a bounce off this moving average is very bullish, while on the other hand, if it closes back below it again, then obviously it's bearish. Let's move over to Google's chart. Google is showing a bit of positive or bullish signs, but just a little bit, not enough for me to call it bullish. Check out last Friday's candlestick. It closed above the green zone that I drew, as well as the 50 moving average. That's positive, but that's about it. Come this week, let's see if we can get a clearer direction or indication. For a better bullish indication, it needs to close above the 38.2 Fibonacci level at around 166, but that's just one small step forward. If you could recall, I always share how 50% Fibonacci level is the so-called pivotal level, so watch this level closely this or next week. This level is around 174. Personally, I will expect some form of resistance around here, because this is near where the 200 moving average is. To be exact, the 200 moving average currently sits at 171. But if somehow Google can put a few green candles above this 171 to 174 area, then I will say the trend for Google is on the bullish side already. For a blowout bullish movement, it needs to get above the critical 61.8 Fibonacci level at around 182. Okay, when I'm away for the next few weeks, if Google can close above this level, it's very bullish, and I would expect a large part of the big gap to be filled, which means Google will be in the 190s range. Okay, but on the other hand, if Google gets rejected at either the 38.2 Fibonacci level or the 200 moving average, watch that green zone as a support zone. If it falls below temporarily for 1 or 2 days, it's fine. But if Google starts closing below it for more than 3 days, I would expect Google to fill that tiny gap between 152 and 153. And if it doesn't bounce after the gap fill, be prepared to see Google in the 140s range again. Let's now move over to Meta. So earlier on I said that Tesla's chart looks interesting, but I think Meta's chart looks even more interesting. Reason is because the post-earning gap up has brought Meta above the two crucial 50 and 200 moving averages. More importantly, it managed to close above both of them last Friday. That's obviously bullish. If we don't get a sudden negative news from Trump, I actually think Meta still has some room to go up. Minimally, it should test the 50% Fibonacci level at around 610. That's also where the 100 moving average roughly sits. If somehow Meta can get above 610 this week, that's like claiming 3 key moving averages within a week. From there is a high probability that Meta will test the crucial 61.8 Fibonacci level at around 640. This 640 level is important as it acted as a resistance in the past, which means once this breaks, once Meta gets above it, it can really fly. On the other hand, please be prepared that investor sentiment can change fast, and a lot of things can happen when I am away in the next few weeks. Any sudden change in the market sentiment, I'm not kidding you, the odds of filling that 2 gap ups are pretty high in my opinion. And among the 2 gaps, I would say pay more attention to the first one between 549 and 570. If we close this gap entirely, it will bring Meta near the green support zone. Meta might enter back into the zone, which is fine. But more importantly, it needs to bounce around this area, whether is it off the green zone or off the gap. It basically needs to bounce, because if it doesn't, then the bottom gap is almost certainly will get filled, which means Meta could be back in the low 500s range in the blink of an eye. Alright, next up, Microsoft. Wow, Microsoft. I rarely see such a huge gap up in the mega cap company. That post-earnings gap up has pushed the company past Apple to become the largest in the US by market cap, at least for now. I'm so glad that I stepped in for Microsoft when it was in the 360s range. Anyway, I know the chart looks bullish, but that's what has been printed on the chart, that's the past. So what's next then? Okay, this may be an unpopular opinion, but believe it or not, I do think there is a high probability that Microsoft will pull back to fill that huge gap. It may not fill the gap entirely, but I think it will fill at least a portion of it in the short term. This huge gap is between 396 and 425. Furthermore, the RSI is approaching overbought soon, so a technical pullback is imminent. Okay, but don't get me wrong, I'm not saying the share price will crash. Within the gap, there are a few key and strong support levels, namely the 200 moving average at around 413 and the 61.8 Fibonacci level at around 408. Coincidentally, 408 is also where the 100 moving average is. So if we don't get crazy bad news from Trump, even if Microsoft pulls back, I think we should bounce from either of the support levels that I have just mentioned. In the worst case scenario, we might fill the gap completely, but check out where the bottom of the gap is. It is the 50% Fibonacci level at 396, as well as where that green support line is. This is a very strong resistance turned support level, and I think it should hold. Alright, to be honest, when I'm away for the next few weeks, I really don't see Microsoft breaking all those levels that I shared, unless of course Trump does crazy stuff again. If he really does that, or if somehow I'm wrong in my analysis, I would be happy if Microsoft can fall below 400 again. I mean, for those who have missed the recent book, wouldn't you be happy as well? In terms of the upside, if Microsoft can take out the January's high of 447, then there is a high chance that it might push towards a new all-time high by taking out 455 as well. Okay, last of all, Nvidia. Well, Nvidia is moving within a very predictable pattern as it continues to grind up towards the top end of the downtrend channel. One positive note is that it has closed above the 50 moving average, which sits at 112. But the potentially negative note is that the share price is hitting the top end of the channel. This means there is an increased odds of rejection. Coincidentally, the pivotal 50% Fibonacci level is also right at the top end of the channel, sitting at around 120. Personally, I am expecting heavy resistance at this level. However, if I'm wrong, I stand corrected, and if Nvidia can put a few nice green candles above 120, I have to be nimble to acknowledge that I'm wrong and change my stance. Because above 120, it means Nvidia will be out of this downtrend channel, and that will be the first time it's happening since the start of this channel back in November 2024. Outside of this downtrend channel, the next heavy resistance area is between 125 and 128, formed by the 200 moving average and the critical 61.8 Fibonacci level. Once again, I expect some form of resistance here, but doesn't mean it's bearish, because Nvidia could jolly well do a retest of the downtrend channel and rebound, and that is definitely bullish. On the other hand, just a quick one, if you would like to support this channel and are looking for a new low-cost brokerage, you can consider signing up for a long bridge account using my referral link. Deposit $2,000 and I will get a referral fee. Okay, back to business. If Nvidia does get rejected near the top end of the channel, don't be surprised if it grinds back to low 100 level where the 23.6 Fibonacci level is. In fact, I wouldn't even be surprised if it is headed towards the bottom end of the channel, which is in the 90s and 80s range. But whether Nvidia will break below 100 again, I think it does depend on the macro factors, the broader market, and of course Trump's tariff news. Moving over to the options trading section, just one trade to update this week, which is this cover call on Google that expired last Friday 2nd May. The strike price was $175 and the contract was sold on 25th March. If you could recall, I got assigned with 100 shares of Google at 175 strike price on 19 March. After the assignment with the help of technical analysis, I deduced that Google has a decent probability of bouncing up, and so I waited to make a move. True enough, we saw 4 straight green candlesticks as Google rose 4% in the next 4 days. And to be honest, I was lucky enough to step in on 25th March to sell a covered call when Google hit its short-term peak. In case you don't know, covered call is a slightly bearish move. And right after I sold my contract, Google fell to as low as 140 in the next 2 weeks. Though it rebounded later on, it did not go close to my 175 strike price. As a result, the contract expired last Friday and I got to pocket the full premium of $515, which is more than 650 Singapore dollars even if I deduct the transaction fees. Pretty juicy premium, right? Alright, let's share some of my thoughts. First of all, I must say the stock market has made an incredible comeback since President Trump announced a 90-day pause on his main tariff plans. Over the past 2 weeks in particular, we have seen strong momentum in the stock market, driven by various non-tariff related good news, such as solid corporate earnings, softer than expected inflation data, as well as strong jobs report. But if there's one thing this episode highlights, it's how quickly market sentiment can shift. We saw the initial sell-off when the tariffs were first announced, followed by a sharp rebound after the pause. It's a reminder that markets are highly reactive and sensitive to tariff-related news, and that this current rally may be riding on optimism, especially around the trade negotiations. That brings me to a key point. Don't get too comfortable or complacent. It feels like the market is pricing in a positive outcome from the ongoing trade talks. But here's the risk. If things don't go as expected, we could see another sharp pullback. The rally could unwind just as quickly as it began. To put it simply, the stock market is hanging on to any hope of progress in the trade dispute. But let's be real, these gains are fragile. They could evaporate anytime. A sudden reversal from Trump could send markets sliding down again. Okay, but that said, there's no point in trying to guess when or how Trump might change his stance or mood. If you are like me and bought the dip last month, enjoy the rally while it lasts. With the ongoing tensions surrounding the trade war, I believe we will continue to see pullbacks, and with that, it means more opportunities to accumulate shares. Personally, right now, I'm not chasing this wave of optimism. To me, the trade war is far from over. Sure, it's nice to see the US and China making slow and steady steps towards negotiation, but the real question is, are we really moving towards a resolution? And if we are, how long will it take? On top of that, we still don't know what will happen once the 90-day tariff pause ends. If you have been asking yourself the same questions, that just shows one thing. There is still a lot of uncertainty. And where there is uncertainty, rallies like this can be fragile and short-lived. Bigger pullbacks could happen at any time, so it's important to stay mentally prepared. Just to be clear, I remain bullish on the US market over the long term, but in the short term, expect volatility, expect sharp pullbacks, and yes, expect big rallies too, like what we have seen over the past 2 weeks. With that, thanks for watching and I will see you in the next video. Don't forget to give this video a like before you go. Thank you very much.